This week, the tax challenge. How much money can you make and how little tax can you pay? Specifically, I've set them the challenge of optimising the tax, assuming that they're earning £200,000 a year. So are you going to do that by using dividends? Are you going to put it into your pension, your SIP or your SAS? Are you going to use capital allowances? All of these questions will be answered over this week's episode. Watch and decide who's your favourite, and I'll be back with you at the end.
With my 200k generated through our LLP, we run serviced accommodation and commercial property. So what I've done is taken it as post expenses, so it's income, not including tax. The tax hasn't come off yet, but it's post expenses. So try and keep it fairly simple here. What we're looking at is I've taken, just based on one of us, is 12.5 basic allowance for income tax. And that would kick off national insurance of 625. I've taken the base rate dividends at 2,000, and I've taken 30 grand dividends at 7.5%, so that you can take up to about 39,000 at 7.5%. So I've taken 30,000 as 7.5%. I have then, so that would generate 7.5% on that would be 2,250. So div 3. And then from that, I've taken SAS contribution of 28,000, and that totals in at 75,325, if I'm not mistaken. So total 75,375, which leaves a balance of 124,625. What I was trying to get to with this is leaving myself 100 grand that I can use as a deposit to buy commercial property, or have as a 40% deposit on a commercial property with a purchase price of 250. So to get down to this, we are looking at purchase price 250, deposit 100, and development costs of 150,000. These are rough numbers here, so don't get too precise on the capital allowances that I would generate. But what I'm looking at here is trying to generate capital allowances to really bring back as much of this as we can. Based on the purchase price, you can claim up to about 45%. So I'm going to work this on 30%, just for argument's sake, just to take off any unexpected. So 30%. Which would kick off 75 grand. On the development costs, you can claim up to 100% of the development costs. So we've got 150 there. So 100%, 150, which takes us to 225. So based on where we are with the total tax, up here, we're looking at a total tax on the balance of the 24,625 of 24,925. Let me know if you're keeping up here.
Yeah, I've got it.
24,925. Plus the dividend tax, plus the income tax, or national insurance, sorry, takes us up to 27,800. Where I'm looking at here is now that capital allowances generated from this commercial investment is going to kick off 225,000. We're looking at 27,800 for tax based on the 100 grand, 120, where is it? 124,625 left in the LLP. And that would give us a balance closing at 197,200, which means we've got a total tax bill of £2,875, which is essentially taken from this here. So it's given a little bit of income. All the expenses are already taken off through the company, and we have got a balance of capital allowances of 197,200. All right?
for future years.
Yeah.
As my physics teacher would say, brilliant but fatally flawed.
Okay.
So, what's up with what you just said? I think you said borrowing.
Yeah, it's going to be development finance.
So the 40k is 100. What I think Chris is assuming is he puts 100k down on a 250k property and then borrows the rest. So I'm fine with that. Okay, I think this is one of those situations where it's so obvious and it's right in front of your face that none of you are seeing it. You said all this is in an LLP, yeah? Mm-hmm. Yeah. LLPs don't pay dividends.
We've got an operating company.
Oh, we've got an operating company as well, but you didn't say that. Well, that's the entire reason why I use an OpCo-PropCo structure.
Yeah.
Because if you tried to do that, and you went to the accountant to see that, the accountant would probably have a hearty laugh,
right,
give you a bill. So really important everybody understands this. A big part of your strategy there was paying dividends from an LLP. Well, an LLP can't pay dividends.
No.
And that is an absolutely fundamental reason why we have OpCos and PropCos, operating companies and operating companies and property companies. So that way we've got the flexibility of the hybrid of the benefits between limited companies and LLPs. And this is, this is an advanced group, so we're going to a level of detail that I would never normally even talk about. But that's fundamental problem number one. Mm-hmm. Fundamental problem number two is, yes, you would get capital allowances, but you wouldn't be able to claim all of the capital allowances in year one. They're expensed over a number of years. Now, if you'd been doing that for X amount of years, then yes, you would be able to claim current year capital allowances. So please never assume that you can have 100% of the capital allowances
in the first year,
the current year.
Yeah.
But if you've got capital allowances over a number of years, then it's going to come out in the wash.
Yeah.
That's the second thing. The third thing, and this is specific to LLPs' income is always taxed. So the fact that you're reinvesting 100k,
still going to pay tax on it.
You've still got to pay tax on it.
Yeah.
So could you do that? Could you make something very similar to that happen if you were spreading that money between the LLP and the limited company? Yes, you could, but the way you just described it to me there wouldn't work.
Okay.
And this is one of the major reasons that I wanted to do this exercise, because when your income goes into the hundreds of thousands or millions, you need a completely different type and level of advice. Mm-hmm. Because it's relatively simple. I don't want to oversimplify it, but most accountants can get you to, let's say, 100k through a limited company without too much drama, because you've got a pension contribution, you've got some salary, and you've got dividend tax at no more than 7.5%. So can you all see how that would work? 30 odd K of dividend at 7.5%, a couple of grand free, 12 grand of salary gives you roughly £50,000, and then roughly £50,000 combined into your pension plus a few expenses. Yeah. There's 100k. Yeah. So it's not difficult to get 100k out of a company relatively tax efficiently, which is why on purpose I went for 200k, because you're going to hit all these sorts of things. Having an LLP or a limited company in isolation is often not enough.
Yeah, yeah.
And that's why we choose both. Because if you only have an LLP, you cannot ever pay dividends.
Yeah.
The way in which reinvested profits are dealt with in limited companies is completely different to how it works in LLPs, which is why I think pretty much every training you'd ever see me talking about, I keep talking about OpCo, PropCo.
Yeah.
All right, how much did you learn from that exercise?
Quite a lot.
Quite a lot.
Back to school.
All right. Anything else to pick up on there?
Basically just how it's all divvied up and how you split the money between the two companies to be able to achieve that.
All right. Well, as an action point, are you going to take away to have a bit of a closer look at the OpCo PropCo thing?
Yeah.
We've got £200,000 coming in every year from now on in, and I'll explain what I was planning to do with it to to deal with tax issues. So we have the 200k. I'm assuming at this stage that it's made up of commercial property that is providing the income, and I'm assuming it's within an LLP. Now, we could also have put all the operational side into a limited company, which is probably what we would do, but for the sake of the exercise, I've treated it all being in one place, income coming into one place, and just taking it from there. And I've made a basic assumption that I should be buying a property every year. So I'm assuming that I purchase every year. The reason being that not only does it build up the portfolio over time, but we get the capital allowances because it's commercial property and it's within the LLP. We will get the capital allowances, which hopefully will mean we eliminate most of the tax that's coming in. I said, supposing we take every year the investment of a new property of 100k and use half of that for the new investment. I reckoned on the basis of things I've done so far, we could probably put down a 25% deposit and get a 400k purchase price on that, borrowing 3/4. And if you buy something that doesn't need work, again, I'm trying to keep it as simple as possible, going for 10% return on that, you're going to get an income of 40k per annum going forward on that. Barring anything else, if you were paying a standard tax on that, I reckon you'd probably be paying at 40%, so you'd probably be paying about 16k in tax on that. So that was on the first 100,000 of what's in there. Then I said, let's look at the next 100,000, which we're not investing. We're going to keep that and spend on a variety of things. I assumed 40k into the pension pot, again, because that builds up and you can use the money for commercial investment afterwards. So it's 40k pension. I assumed a payment to myself. In all of these cases, I haven't actually brought in. I do have a partner and I do have a child, so there are other things that can be done here, but trying to keep it simple for the time being. You've got 12.5k income that's free, effectively, that's tax-free on a salary. And because it's an LLP, I didn't assume any dividends. I just assumed then the rest of it that would come here. That's just over 50,000, so it's going to be what? That 47,000. The remainder would be a salary on which you'd pay somewhere between 20 and 40%. So if we said about 30% of 50,000, that's about 15k in round terms. So that's how essentially I would divide it all up and do this on an annual basis, so every year following the same pattern. Out of all of this, then I will have got an income of 40k from the new company and 60k here, so that's 100k actual, it's, if you like, cash earnings, the rest having gone into investment or pension, which again you feed back in, and there'd be roughly on the total about 30k in tax coming out of that, which would be at about 15%. I'm assuming then the capital allowances, if we assume somewhere between 30 and 40% on this 400k, so it's going to be between 120 and 160, say 140k in there, and you build that up every year, you're going to have quite a lot of capital allowances. It's certainly going to take out all of the the tax bills you've got there. I haven't assumed things like national insurance. Of course, there's going to be little things, but I'm afraid I don't do well on the small numbers.
No.
I like to think in terms of big round numbers and what the top line looks like. And so there's the fourth key element in that box, is the capital allowances effectively mean you don't pay any significant tax on the income you've got, and you'd be having 100,000 that you could go away and spend on what you liked.
Okay, so what do we think?
Richard, you said that 100K first one, which you want to invest in a property,
Yes.
because it's in LLP, you have to pay the tax on that as well before you invest that 100K. It's
Okay.
similar to Lease.
Well spotted.
Right.
Just because you're reinvesting it in property doesn't mean you don't have to pay tax on it.
Right. Okay. Whereas if it's in a limited company, I could reinvest without paying tax.
Well, you're effectively shifting it from the P&L to the balance sheet.
Right.
You're creating an asset in a limited company. And while an LLP has got a balance sheet, you've still got to pay tax on the earnings.
Right. Okay.
So,
missed that.
okay, so nice and simple, everything inside the LLP. Similar comments I've made to a few others. If you don't have an OpCo, if it's just in an LLP, you're going to miss out on the benefits of having a limited company. One of the key ones being, apart from anything else, risk. So is what you're doing particularly risky? Not really. I mean, if you've only got commercial property and you're thinking about shops and offices and things, and there isn't really much operational risk, well, fair enough, you could have it as just an LLP. Making the assumption that you're purchasing something every year, I agree with you, and you know because you've done it. Can you take a 100k deposit and turn it into £400,000 worth of property? Well, yes, you can. And is that on its own going to be enough to defray £200,000 of tax annually? Probably not. So you...
Okay, yes. Bearing in mind I underestimated the tax. Need to
now, how do you increase your capital allowances? Well, you either buy properties that need work,
yes,
do service accommodation, or something else. So could you specifically use strategies to increase your capital allowances? Probably.
Yeah.
And therefore, might you be very far away? Well, not really, because if you're taking your very top line, £200,000, you put in £40,000 into your pension.
Yes.
You put in £12,500 as salary.
Yeah.
Well, that's 52.5. So your 200 becomes 52.5. And you're saying 140 of capital allowances, you're probably only looking for 10,000 or something. So you're not very far away, and I think as a simple strategy that most accountants could implement for you, it's extremely simple, which I think is beneficial for all sorts of reasons. And I think you'd be plus minus £10,000 away per annum from being able to do it. And the few £1,000s that might the gap be is probably going to be your national insurance bill anyway.
Right.
Yeah? Mm-hmm. Nice and simple. Round of applause, please. Thank you.
The way that I decided to sort of manage the 200k is in a hybrid structure. So here goes. What I tried to do is I tried to have a holding LLP at the top with 2 partners, one being my serviced accommodation, one being my commercial property, and for argument's sake I had each of them turning over the 100k. A third limited company here, so that's limited company 1, 2, 3. A third limited company here, this is where I wasn't quite sure. With a subsidiary here, I tried to keep it as simple as I could, but
Failed.
but failed.
Can't be, look, Lee, other people want limited companies. Companies House is going to run out.
I think it was a bit overcomplicated, to be honest. But anyway, and then what I did here
God,
is...
there's more? Bloody hell. Need more pages.
Yeah, I don't fully understand it, if I'm honest.
Never. Surely not. Your
Right.
accountant's just retired and gone to Seychelles. All the money they've taken off you.
Yeah. Anyway, right, so what I did is I've also got a SaaS, yeah, and I went back 3 years.
Okay.
So I took 80k out of there, leaving 20k, because you can go back 40k a year.
You can, yeah.
And I took 40k out of there, leaving 60k. So that's 120k off the 200k into the SaaS to buy more commercial property, tax-free. Yeah?
Yeah.
With the cash that's left, I had car expenses of 20k. That's to buy, to lease and to run, yeah. Which was put through the LLP, which knocks that off out of the equation. Out of the 60k here, no, sorry, this is made up of 10k there and 10k there. So that leaves 50k and 10k. And then basically from these here, I paid dividends, 7%, up to the value that you can pay dividends up to, and tax on the remainder of the, no sorry, I took 4k tax-free dividends, yeah, 2k out of each, and then I paid 7% on the dividends from this company and this company here. I didn't get to the final figure of what I was paying tax, but that was the thinking behind it.
Is that more or less it? Okay, well let's start from the top then. First, you're structuring this so that the LLP owns various limited companies, yeah? Is that what you're saying?
Yep.
So you mean this is a holding company?
Yes.
Okay. Strong advice, don't do that.
Okay.
The whole point of an opco-propco is to separate the two entities from a risk point of view.
Right.
If you've got one entity owning everything, if this bit blows up, everything else will blow up. And I don't mean that for any nefarious reason. I just mean things happen where, you know, it's a part of corporate life that corporations fail. Nobody does it on purpose.
Yep.
If you don't believe me, look at Woolworths or Toys R Us or, you know, whatever. Nobody crashed those businesses on purpose. And that's the reason why I always put, personally, I always put my assets into a property company, and I put my operational elements, including the risk, into my opco.
Yep.
Thing number two, the most overwhelming thing that I got from that, Lee, was complication. And life for me is really, really easy. An LLP and a limited company. That's it. That lot in there. Okay.
No, I'm all for keeping it simple.
All right. Next issue. You didn't really say who the partners in the LLP were.
No.
You have to. Now, if what you meant was your limited companies are corporate partners, well, fine. But if you've got corporate partners, that's fine. But you have to have at least one human being, which, you know, could be you. But you can't have an LLP without at least one person.
Okay.
the thing that you've missed there is you can't put more into your pension pot than you earn. Now, if you're only paying yourself, by the time you're taking the car out and everything else, you said you were going to pay yourself from those 2 limited companies as dividend.
Yeah, about 40k.
You said you're going to pay yourself 40k or whatever, you know, which is fine. But that means that you can't put more than 40k into your pension. You could, if you'd earned more.
Right.
But the 40k is the greater of the absolute limit.
Yeah.
Sorry, but it's restricted to the amount of salary and dividend that you take in a year. So you couldn't actually do what you're trying to do there.
Yep.
And for me, this is a great example of what an accountant wouldn't be able to help you with, because if you've made those decisions before your company year end, and then you went to the accountant with those plans, he'd have to say to you, well, sorry, pal, you can only put 40, well, whatever it was, 50k in the pension, which means you get whacked for tax on £70,000 that you weren't expecting, which could hurt, couldn't it?
Well, yeah, it would do,
Yeah. And then to Richard's point, you said, Richard, can't remember your exact words, how do you move money between companies? If the companies are providing services, then they can invoice for that. Right. And you can pay the money across like that. You can do, so in other words, you said MSA was my service departments, and you said the other one was your commercial property company. So if your commercial property company did some consultancy or something for your service department company,
charge it.
It could raise an invoice, and then you would pay the money across. So yeah, and you can loan each other, so that you can make intercompany loans. And the absolutely critical time to get all of this sorted out, because as soon as you've got multiple companies and you have done things like, and there's no reason why you can't do things like lend money from this company to that company, on the last working day of the year end of that company, the shutters come down, and whatever the bank accounts say at that point has got to be reconciled back to. So, you know, and you can make these wonderful things called accruals, and you've got some manoeuvre room, but you really need to be having those conversations with your accountant minimum of 2 months before the year end of the company concerned. And I've seen people end up with 12, 15, 16, 17 companies, which means effectively they've got 1 to 2 year ends every month. So there's all sorts of reasons why you don't want too many companies. So keep it as simple as you can. And there's a school of thought that says you should have the year ends on the same day, because that makes you line everything up. And there's a school of thought that says you shouldn't, because that way you can get some benefits from having offset year ends. So my overwhelming feeling with that was a bit over complex. You probably need a bit of help and direction with structure, because this is going to be a live issue for you, because what you got now, 7 service departments? And you're already through the VAT thresholds. And so don't leave it to the day after your year end to go and get the support you need. You really need to take some advice from someone that's already done this. And there's plenty of people in the community that have got service accommodation businesses and commercial businesses combined. And the simpler you keep it, and the more like somebody else's you keep it, the better it's going to be for you. So you need a living, breathing person that's actually done it, and an accountant to do what they tell you to do. Is that all right? Round of applause for Lee. And as an added bonus for you, when the Millionaire Makers have been, I shared some thoughts and principles on how I would do it. Because I can still remember when I used to earn hundreds of thousands. So you need to keep educating yourself. As your income goes up, you need to make sure that your tax knowledge, your ability to call on the right power team, also goes up in line with your education. Otherwise, you are going to pay far too much tax. Let's get to it. I hadn't really planned to do this, but would it be useful if I have a go at saying, well, what would I do with £200,000? So,
You will get the most votes.
Yeah. Well, I think I forgot to enter. So I haven't got any votes at all. Every single person in this room has got more Millionaire Maker votes than me, because my name's not on the list. And if you're watching, by the way, everybody out there in YouTube land, wherever you're watching, That's weird, isn't it? This bloke Paul keeps appearing even though he's never got a vote in his life. He's still in the competition. Okay, so if you've got a property company and you've got an operating company, so an LLP, a limited company. So this side we have PropCo, this side we have OpCo. So many of you said during your presentations that you've got limited companies that do service accommodation. Some of you talked about commercial properties for other reasons. But of course, once you've had a service department company for a few years, one of the ways that you can buy buildings is by writing a lease. Now, a number of you said that you would only have one or the other. Now, if you only have one or the other, you clearly can't write a lease between a company that exists and an LLP that doesn't exist. So a very, very strong reason to have both is that your ability to do this once you've got a strong set of service accommodation books is a fantastic way to go and buy buildings. Yeah. So Lee's question is, does it matter if your SA operating company is a rent-to-rent, or if it's buy-to-lets that you already own? So in other words, do you own the asset or do you not own the asset? It doesn't matter, because the strength of the service accommodation trading company, the OpCo, is that it knows how to run service accommodation. So I think I'm rightly in saying that your 7 SA units just now, they're all rent-to-rent, yeah?
Yeah.
So it doesn't matter. Whether it's an LLP or a limited company is critical in the sense that over here you can pay dividends. Over here you can't. And there are some generous tax breaks for dividends that you all know about, but if you only have an LLP, you can never claim them because you don't have that structure. So I think from a dividends perspective, the one that wins out is the limited company. The one that loses out is the LLP. So again, have both. All of you correctly picked up on pensions. Pensions, for me, they're entirely neutral. They're both a great tax benefit, and it doesn't particularly matter whether it's in an LLP or a limited company. You'll get the same level of benefit wherever. What you may not know, so I'll make sure you know, is if you're going to set up, a number of you, well, most of you, I think, talked about SASs, not SIPs. Now, a SIP is just for you, and it has no relationship with a company. A SAS has to have a sponsoring company. So if you came up with some scheme whereby you're going to own all your property in your personal name or something, you need to have a sponsoring company. And so it can't be you can't have a SAS if you don't have a company, is what I'm saying, to put it back to front. Other considerations, a number of you, as you were free to do in that exercise, assumed different types of property. For what it's worth, commercial property and service accommodation, we own in LLPs. Buy-to-lets and HMOs, we own in limited companies. So that would also have had a bearing on my decision, because if you remember, I've probably said often enough, the 3 main reasons to choose an LLP would be capital allowances is your number 1 reason. But if you're buying buy-to-lets, you're never going to have any capital allowances, and therefore the number 1 reason to have an LLP doesn't exist anymore. Number 2 is a car from an expense point of view. Well, if you've got at least some properties in an LLP, you can only have 1 car per person anyway, so that reason disappears. And the third, and most important reason that I didn't hear any of you talking about, where I would bias a lot of stuff to LLPs, is anything to do with IHT, inheritance tax. Now, you could argue that what I gave you was outside the scope of that, but it's something you should all be thinking about in terms of tax planning for the future. And I think the one that wins out time and time again for inheritance tax planning purposes is an LLP. Why? Well, it's fundamentally to do with gifting, and at the end of life, well, the inheritance tax threshold is extreme. Well, given that we're talking to a group of millionaires, it's extremely low, because the inheritance tax threshold, pardon me if I'm £10,000 out, but I think it's about £340,000. And then they've introduced a rule that means you can effectively double that because of your primary principal residence. But roughly, if you've got assets over and above £250,000 and you don't take inheritance tax planning measures, you're going to end up paying 40% on everything. Well, not you, but the people that inherit it are, your kids or whatever. And so if you've got a £10 million portfolio that's not properly advised, you could end up with a £4 million tax bill, or they could when you're dead. And the main way people try and manage that with a limited company is they gift it. But now you've got to be psychic, because you've got to live for 7 years. And the bigger problem is that when you gift the asset, you can't enjoy the benefit. So what you're going to live on for the last 7 years of your life, or whatever. So it's just hard to do inheritance tax planning. Whereas with an LLP, the income from the asset and the asset itself can obviously be split. So you can have an LLP that you don't gift, and the simple way you leave an LLP is just when you pass away, and you can bring in your kids at whatever age, or whoever you want to pass the stuff on to. So it's just a much, much cleaner way of managing inheritance tax. So these are all kind of valid considerations when you're thinking about these things. As I said, for probably half the room, this is a live thought process about, well, maybe I'm not at 200k yet, but I'm heading that way, so how am I going to manage this money? So my task was, what are you going to do with 200k? So you've paid all your essential living expenses, but that doesn't mean you can't charge more legitimate business expenses to your business as long as they're legitimate. So in the limited company side of my business, what am I definitely going to take advantage of? I'm definitely going to take advantage of dividends, because why on earth wouldn't I? And you all picked up the 2k. Now it's tiny, but you might as well have it. Wherever you've got your pension, I'm definitely going to take advantage of my 40k limit. And you might be thinking, well, Paul, you can't do that because you're a pensioner. Well, I can, because I don't have to stop doing that even after I retire. So, and I haven't retired yet. I can retire, but I haven't actually started drawing my pension, because for Christ's sake, it was only on Saturday. But I'm probably not going to do it for a few years yet. So pension, whichever side of the fence it's on, is pretty much going to be 40k a year forever, because why wouldn't it be? Other little bits and pieces on pensions. Few of you mentioned you had children, whatever. So just so you know, the youngest age at which you can have a pension is 16, and you can make a contribution to that pension of, I think it's £3.5 or £4.2? So either £3.5 or £4,000 a year, even if they're not earning anything. So you can just put £4,000 a year into your child or your grandchild's pension fund, which is from the age of 16. So by the time they actually start work, they might have 30 or 40 grand in their pension fund already. Next, and I don't care where this comes from, doesn't make any difference, I'm going to have a salary, 12.5k, and I think you all pick that up. Why wouldn't I take my salary tax-free? I might do what Nick said and jump it up to 25k if it impacts on my lendability from a borrowing point of view. I would. One of you mentioned, was it you, Chris? You said if you pay yourself 12.5 grand, your national insurance bill is 650 quid. Did you actually calculate it, or do you know it? Or?
I just know that's what it is, because I pay myself that.
Oh, right. Fine. So national insurance, I would want to pay that £650. So I would volunteer that tax. I'd do it for two reasons. One is kind of a bit like Nick, I think it's reasonable to pay something. But two, check you all know this, if you don't make national insurance contributions for enough years, you won't get your old age pension. That's what it's for. You're contributing to your old age pension. And if you work out what you pay versus what you will get back, provided you live to, what is it these days, 67, whatever it is, you'll start getting back 700-800 a month, won't you? So, yes, it's a tax, but if you don't pay the tax, you don't have to, you won't get the future benefit of an old age pension. Assuming it still exists by the time we're all that old. Okay, so we've done dividends, we've done pension. So dividends has to be this side, pension could be either side, salary could be either side, national insurance could be either side, doesn't matter. Capital allowances. Half of you talked about capital allowances. I would definitely have capital allowances on this side, because I would definitely want the money, I'd want the cash tax. So how much of that I put over here will be determined by how much capital allowances can I claim every year. Well, that's going to be my only consideration. I won't consider anything else. And if it's hundreds of thousands of pounds, fantastic. So you're going to have cash that's tax-free. And the more capital allowances you got, then the bigger this number gets over here. And that is the main way that Aniko and me use capital allowances. So we're currently sat on, I think she told me, we got roughly 3 million quid's worth of unclaimed capital allowances. So the next 3 million that we earn, zero tax, but we've got to pay national insurance.
A year or so then?
Well, it would be if we weren't buying more property.
Yeah.
So our capital allowances aren't particularly going up or down, they're sort of staying about the same. Because, for instance, I think you all know what I'm doing with my house. So just that alone is going to generate capital allowances of about 2/3 just that one transaction. So it kind of goes up and down a little bit. And yet, you now know why I carry the 2% national insurance in my head. I know that I'm going to pay the maximum national insurance every year pretty much. And when I go over that, I'm going to pay 2%. So my effective tax rate is 2%. Because what else in this lot am I paying tax on? Well, yes, that's tax. But what I'm exchanging it for, 67 plus, is I'm going to get the old age pension, aren't I? So you could consider it to be tax, or you could consider it to be a saving. I've got to pay 18% corporation tax on £2,000 per person. Well, okay, it's £360 or something. And so my effective tax rate is 2%. And that's where you should really be heading. And I'm not aware of any way that you can do it other than having a limited company, LLP structure, which some accountants call the hybrid structure. So if you hear people talking about the hybrid structure, that's what they mean.
They're completely separate. It's not like one piece.
They're separate.
Or shareholding in the other.
Yep.
There's no link between.
Totally separate. And you see so many people that try and overcomplicate it for whatever reason. Now, I do have, yeah, Lee, I do have, me and Annika do have a number of different trading entities, but essentially the structure is always the same. And the only reason that we would have a different trading entity is if we've got different partners. so a different JV partner. So our structure might look complicated, it's not really. We've got LLPs, one LLP, and so my effective tax rate is 2%. And that's where you should really be heading. And I'm not aware of any way that you can do it other than having a limited company, LLP structure, which some accountants call the hybrid structure. So if you hear people talking about the hybrid structure, that's what they mean.
They're completely separate. It's not like one is
They're separate.
or shareholding in the other.
Yep.
There's no link between.
Totally separate. And you see so many people that try and overcomplicate it for whatever reason. Now, I do have, yeah, Lee, I do have, me and Annika do have a number of different trading entities, but essentially the structure is always the same. And the only reason that we would have a different trading entity is if we've got different partners, so a different JV partner. So our structure might look complicated, it's not really. We've got LLPs, one LLP, one limited company for us. Then we've got one LLP, one limited company for any other JV partners we happen to be working with, and that's it. Our pension has to be attached to one of those companies, and it is. There's probably one more thing that I should mention. If you've got capital allowances in an LLP, it wasn't really relevant to the exercise, but are you all aware of what sideways relief is? Okay, so fine. So sideways relief means you can offset tax or taxable income of up to £50,000 per year from somewhere else. It's most relevant if you've still got a job. So the doctor guy that I was talking to in London, he's a doctor, obviously, so he gets paid for being a doctor. So if he wanted to, he can use sideways relief. So if he's got some properties in here, he can offset £50,000 of his GP salary to zero using sideways relief. So, but it wasn't really relevant to the exercise I gave you, but in case it's...
Is that the only use for it?
Sideways relief, yeah. It's just offsetting other income or tax on other income.
Is there any, you can go back or something, or you can't? It has to, you have to have a job at that time when you...
Well, you have to have a job, you have to have other income. But yeah, no, you can't go back 200 tax years or anything.
What is he setting his 50k off against?
His GP salary. So let's say over the next year he builds a substantial property portfolio. He can only offset income in the LLP using the capital allowances. But for many people, as well as a limited company and an LLP, I haven't got enough room, but they've got another box or column over here called PAYE job. Yeah? But you can't offset against something that doesn't exist. The question was, and it's a great question from Bavin, you're thinking buy-to-lets or something.
Yeah.
So Bavin's got some buy-to-lets in his, I've got some buy-to-lets in my personal name still. So if you've got another income source, you're earning money from your existing buy-to-lets and HMOs over here, and that's personal income in your name, which is generating whatever amount of money. So can you use £50,000 per annum sideways relief? Yes, you can. Wow, what about that? Deep insights into a deep subject and some really, really good, solid tax strategies. Hope you enjoyed it as much as I did. Now, the hard part. This is impossible for me and difficult for you. You've got to decide who stays and who goes. And we really are getting down to the sharp end now because we've got so few people left. As the competition hots up, and we've only got a few weeks to go now, we're going to find out who the winner is, which is great for the winner. But it's hard. It really is hard because this group has worked together for a long time. They started working together last November now, so some real deep friendships developing here. So who stays and who goes is really, really important. So can I make a special request? please, please think about where your vote goes, because every vote counts. And we want to make sure, we really want to make sure that it isn't, you're not voting because, well, you vote because of whatever you want to vote for. But it is really important to them. So if they've done a good job, reward them with your vote. As always, you've been wonderful. I've been Paul. See you next time. Watch out for next week's edition. If you've liked it, please literally like it. Subscribe to the channel. Get your friends to do the same. You've been wonderful. I've been Paul. See you next time. Bye-bye.